All right, good morning, everybody. January 7th. So our first Water Cooler Wednesday of the new year coming at you. And it's been a great 2025. I got a good report about the results that we've done. And I'll share a bit of that with you today. And then also get into some criteria of what we're looking for going into 2026. I'm joined by Dwayne Gibbs. Dwayne, Happy New Year, bud.
Happy New Year.
Yeah, I'm looking
Good.
for, yeah.
Yeah, looking forward to 2026.
Yeah,
Absolutely. Yeah.
it's the holidays for this business, it does slow everything down. You get kind of there's a tendency to be a rush towards the end of the year, and a lot of funds are trying to close out their books. Small businesses doing the same thing. The smaller, bigger companies, kind of a tricky time of the year too, by the way, because sometimes the stuff they want to get off their books is stuff that you don't want to buy. It's stuff they want to get off their books because they're not good assets. But other times they are very good assets that they have to sell, which they would probably prefer not to. But once you get through that, things in January start off a little bit slow coming into the new year. So if you're looking at inventory right now, it might look a little thin on what you're looking for, especially if you have a solid criteria, which I do. But that changes, very, very quickly. People get back into it. I mean, for all intents and purposes, most people are back working only since Monday, so it's just been a couple of days and things will absolutely pick up. Um, but there is a criteria that you have to look for. There's a reason why there's some people who've gotten in this business, and Dwayne and I've seen this over the years. They come in hot, they come in buying up everything in the world, and they're going to take over the industry. And then all of a sudden, a year goes by and they're gone. What happened? Well, they got investors chasing them because they bought the wrong kind of notes, and they just flare out, right? I mean, I don't know how many times we've seen that, Dwayne, over the years.
Yeah. They have a mindset of that they're just going to tear in and buy everything up without proper criteria. And you do a great job of, setting that criteria and explaining it to the students so they have an understanding coming into the business. And one really good thing that you did at the end of last year was, and again, we prepare third and fourth quarter going into the new year, and a lot of people just start January running and hey, I'm going to do this. And so I think the ability to be able to broker notes into your program is really good. Um, and I think that you have a set criteria is where I'm getting at. And a
Mhm.
lot of people don't. They just go in and buy things up. And if you're not setting your criteria of where you need to be, then again, it leads back to your point. They're just buying stuff and they have investor capital that they have to deploy. And at the end of it, really didn't perform the way they thought it was. Why? Because they didn't have a criteria set for them to buy. And so they're just buying up inventory.
Yeah, and that's a mistake. I mean, even when I meet with my elite clients, and those are the ones that I partner with on deals, we have an initial phone call where I talk about, well, what are you looking for and set your expectations. But I tell them, I said, look, there's a couple of numbers here that are a line in the sand for the way I operate, and so we don't really need to talk about. I explain what those are, which I'll do here, but I say so that's where we are in that stuff. So let's talk about how much capital you have to deploy and everything else. And it keeps people when they hear that and they understand that, they stop becoming yield hunters. And
Yeah.
that's one trap that people fall into when they move from the real estate side and they get into the paper side of the business. Some people on the paper side get into the money lending side, and some people get into the note side, and some people do both. And I teach on both of those. The people that get into the money lending side are normally attracted by the higher yields and the short-term payoffs. No question about it. You can do short-term bridge loans. You can do hard money type of loans, 6 months to 2 year type of loans, and get upwards of 15%. In a lot of states that's too high. But if you add in points and you add in, the fact that you're getting 12, 13%, it bumps you up to 15 pretty darn easily. And you can do that. The problems become it's that you're also taking on a high risk venture. And that's what you have to avoid, right? Because people get into that and then they find out, well, gosh, this guy was doing so good. Um, he all of a sudden stopped paying, and all of a sudden he stopped talking to me, and he's purchased 40 houses in this area. Yeah, because money sometimes is easy to get. When you have a lot of lenders coming into an industry, a lot of, I should say, investors coming into a lending industry that are fairly green. Money's pretty easy to get. You talk a good enough game and, oh yeah, I do 20, 30 properties. But you got to understand, somebody who's leveraging 20 to 40 properties is also a higher risk person.
Mm.
And it's not a surprise because the dominoes start to fall. All of a sudden, their profit margins go down, or property days on market for resale go up. Uh, they get squeezed, and then they can't afford to pay everybody, and then they just walk away.
Yeah, we also seen where the one that's trying to get the money and talking that game to the investors, they're giving them a preconceived notion of that they can get them an upwards of 15%, 15, 20%. And all of a sudden now they're scrambling to get rid of the deal. And how am I going to do it? And I'm taking a loss and I'm not making any money on it. And so again, they're green to the business and they're giving an expectation to their investor that they're going to get high rate of return, and that you have a market change, and all of a sudden the market goes cold on you. That rate's going to drop real fast.
Oh yeah, yeah. The 15%, the shiny object, is dangled in front of you as an investor. And again, a lot of people not knowing enough about it jump in for that. And you've got to realize in some states, you might be in a state where it takes 18 months to foreclose.
That's what
So
people
if,
don't.
if
Yeah.
you're,
Now
if
what
you're
happens to your rate?
exactly, it's 15% if you get paid.
Yeah.
So what happens a lot of times is these investors wake up to this and they go, I can't afford to make all these payments, so I'll just stop making payments and I'll rent the house out, or I'll change plans, or I'll just keep trying to market the property without paying you. Because what are you going to do? Foreclose? All right, I'll see you in a year and a half. In the meantime, they'll make some money or what have you on stuff. So it's
The
a
worst the worst thing you have to do is go back to your investor and say, well, that 15% I told you, we're down to about 8.
yeah,
We're
because now
down
we're
to
spending it.
6.
And by the way, we need more money
Yeah,
because
we
we got
need
to
more
pay
money.
for foreclosure and we got to go through that. And I'm not saying you can't make money in that type of lending. I've done it.
Right.
I've also taken a couple properties back, in the last crash as well. So if in this side of it where we're buying notes where that somebody else has already created. One of the advantages there inherently is that you've got a note that you can go back and look at the track record. How did they perform? Have they been paying? And it's their house. It's not an investment. The person lives in the property, so they have a motivation to keep the roof over their head in the note space. In a single family home, owner occupied is normally what we see, and they're just making a mortgage payment like somebody would typically do. And that changes the game up a little bit because now they are motivated to stay. They are motivated to pay. They realize that they would lose their house and any potential equity in it if it was foreclosed upon. So it's a higher motivation, but nonetheless, people lose jobs, people get divorced, and there is risk to it. So all in a long way of coming back to saying you've got to have a criteria that protects you. Okay, so the first thing that we look at when it comes to protecting yourself is a very simple ratio, but it's a very important one. It's called the investment to value ratio. That's it. That is a comparison between what you are investing to the value of the underlying collateral. Okay, now we know going into an ITV, the amount that you invest is fairly fixed, right? I'm paying this amount of money for that note. Now you might have other costs and that sort of thing, but you're paying a certain almost fixed amount of money in that. And then you've got a value aspect. And the value aspect is in a way more variable, right? Property values go up, property values go down, property values stay steady. We're seeing right now changes in the overall marketplace, overall being United States in general, where in some pockets they're still going up, in other pockets they're actually going down. Other places have flattened out. They went down. They kind of ran steady. People are waiting to see what's going to happen to mortgage rates. We have supply and demand issues. We have Wall Street companies that have purchased homes for purpose of rent. We have the immigration thing upon that people are looking at. It's like that was driving up, housing costs, especially for lower middle income people, and that's starting to change now. So yeah, there's definitely some different things going on in the industry, mostly isolated in certain areas. But it all speaks to the same point. You've got to look at, well, that's the value of the property right now. What might happen to it in the future? So you've got to build in a buffer. Kind of like if you're estimating what a repair, yeah, let's say you're getting a new kitchen put in on your house. You're going to get quoted offers and those sorts of things. And is that what the final offer is going to come out to be? Well, we all know that no, probably not, because now they put the cabinets in, but then they found that there was this in the background, and then they had to, there's all kinds of things that can happen. So what do you do when you're budgeting on that? You should have built in a little buffer. And of course, you do that when you do rehab properties as well. So the point being is you don't want to come in at such a high level on investment to value ratio where if the property drops by 5-10%, all of a sudden you don't have any potential equity.
Yeah.
And I've seen people do that. And for example, just to use easy round numbers for everybody, if you've got a property that's worth $100,000, okay, so let's frame it this way: you've got an investor who has a house that's worth 100 grand, and let's just say he paid cash for that to keep that part out of it. Keep it simple. Investor paid 100 grand for a property, and now they're selling with seller financing, and they take 10% down. Okay. So 10% means they have a $90,000 deficit. So they finance the $90,000. And maybe they even do it, and I'm going to be extreme here for example purposes. Maybe they write that $90,000 loan at 15%. And then they come to you and say, we'll sell you this loan, this $90,000 loan for $90,000 because you're getting 15%. And the person put 10% down. A new note investor who's untrained or improperly trained, by the way,
Hmm.
would come in and look at that and say, cool, I'm making 15%. Look at me. Industry averages are maybe 10 to 12. I'm making 15% all day long on these deals because this guy's going to bring me even more deals. Yeah, he will.
Of course he is.
Yeah, he will. Because number one, he's selling you a note for $90,000. He's getting 100% of his money, and now he has zero risk. You're paying 100% of the money, and now you have all of the risk. And you get payback over 20 years, over 30 years, over 15 years, whatever it is. How does that possibly make sense? How does that possibly make sense? That's why you buy at a discount, by the way. Plus, what happens if things go wrong? Yes, the person put 10% down, they start making monthly payments, and they lose their job. Then they get divorced, and something happens, and they stop paying you. Well, now you got to pay for foreclosure. All right. So on average, that might cost you 3-4 grand. Okay. But it also costs you a year plus of your life. And you're concerned about the property deteriorating. You're foreclosing on the people who are still living in the house. You can't kick them out. They're still living in the house. And they may not be happy with how things are going. So now, congratulations, you've paid $90,000 for a house that's worth, well, now you're in it for 95, let's say $1,000 for a house that's worth 100. Couldn't you just went out and bought a $100,000 house for 95 grand? I mean, it doesn't make sense, to do it that way. That $90,000 note written at 15%, the most I pay is 70 grand. That's it. Is my yield going to be way, way, way higher than 15%? Of course it is. Okay. But I'll tell you right now, I don't need to get out a calculator to tell you how much the most, by the way, I would pay for that note is 70 grand. All right. So maybe they take 20% down. Okay. Bigger down payment. I like that. More skin in the game. And they create an $80,000 note at 12% interest. And again, they want 80 grand. And I've seen this trend. They want 100% of the balance because shiny object, 12% yield. The most that I'll pay for that note is 70 grand. The most. I don't need a calculator. I don't need to calculate my yield. I don't need to look at my discount numbers in that case. That is what my property is. That's what the note is worth. Now, they might get 80 grand for that $80,000 note. They're getting that from an investor who's not going to be in the note business for long. I'm just telling you, that's how it happens, everybody, because you end up buying these notes, and at some point in time, good notes go bad, everybody. You might get lucky, pay that $80,000, and you get one of those people that just pays on time every month, and you're going, I don't know what you're talking about, man. This note's working like a charm. I'm making 12%. Everybody's happy. Good. Ask how many landlords every once in a while they get a good tenant and it works like that. And they're like, oh, thank God. Ask them how many times it doesn't.
Yeah. They can tell you how many more it doesn't than it does.
Exactly. So the numbers always will catch up with you, everybody, if you're not monitoring your risk. You
So
know,
let me ask you this question. The students that you work with, that you have, that you do your one-on-ones with or your partnership, when you give them this parameter layout,
mhm.
how much pushback do you get from that?
I normally don't get pushback on that because again, they came to me with an open mind and they're paying for my education. That's the difference. So somebody like that who goes, hey, I don't know this business, I'm going to admit that I might have some dabbling in real estate, or I've done a note here or there, or maybe I've even done a loan, but I don't feel that I'm an expert in the business. They come to me for that, and that's why they pay me, obviously, for that information. So I don't get pushback on that because I'm telling them this is the right way to do
Mm,
it. And, that's why, again, been around a long enough time, where if you follow those guidelines, I mean, think about it. Why $70,000 in both of those examples? Because my maximum investment to value ratio is 70%. That's it. I'm not going to be in a deal more than 70% of what it's currently worth. So if I buy that note for $70,000 and the house is worth $100,000, what I'm hoping is that people pay, so my risk goes down every month and the property value goes up. So my risk goes down even further. So my risk goes down two ways, the property going up and the principal balance being paid back over time through the amortization schedule. Okay, great. What happens though if the person's paying and the property value goes down? Now that $100,000 property is only worth 95, you know? Well, I'm still safe. I'm in it for 70. I've got enough of a gap there where if things go bad and I have to foreclose, I will at least make my money back. Probably still make some money, right? If the property value goes down to 90%. Now that's a big drop, right? We had a 10% drop in property values. That would be a huge, obviously we would have major things going on in the economy for that happen, or the local economy there for that to happen. The factory closes, that kind of stuff.
hmm
So, okay, now it's worth 90, but I'm still in it for 70. I'm recoverable enough where, again, if I was in it for 90, now I'm in trouble. Now I'm going to be upside down
Sure.
on the deal, and I've got no choice but to slow play it and try to think my way through it in the long term. So, that's the first thing you have to look at is the risk, because nothing worse than getting in a couple of deals and getting burnt. And believe me, it'll take the most seasoned investor when you're going through a foreclosure with somebody, it wears on you because you're thinking about it 24/7. You're thinking, am I going to lose all my money on this thing? How much more money is this going to cost? How much is this going to cost me in time? Because, then they declare bankruptcy. So things can happen and it gets drawn out and you're worried about your capital and your investment. And of course, not only are you not making the income, but you're paying attorneys, but you're also paying servicing companies more money because they're trying to collect on the thing as well. And that costs them more employee time. So you're paying for that. So your expenses, definitely go up, although there's no money coming in. And some people aren't prepared for that, especially if they've used their IRA money, you know.
We know people that teach differently, that scramble on deals. Um, and I think, just your rule of thumb, it's safe not only for the investor, but it's also a good deal for, the student and the person who's selling the note too. I mean, it's a win-win, I think, for everybody all the way around.
Yeah. Yeah. So if you're looking to broker notes, now brokering notes, arbitraging notes, if you will, you go out, you find somebody, or you're at a real estate club, you're into somebody, and they've got a note and they're looking to sell it. That's one of the criteria you would look at ahead of time to set their expectations. Look,
Hmm.
just so you created this note, you only took 10%. The most somebody could be in here might be as low as $70,000. Would you be interested in something like that? And if they say no, well, then you have to kind of work with them and say, well, how about you just sell a part of the note? So there are solutions. If somebody creates that
Yes.
$90,000 note on that $100,000 property, there is a solution. And the solution is they don't sell the whole note. They just sell enough to get some of the money out of it that they need to get. And that's the thing. I did a land deal like that the other day. Very seasoned land guy, very seasoned, very successful, does very good at what he does. And he wanted to sell some of these notes. I said, well, here's the issue. The most I can pay you is this. And I explained why, just like I did here. It's all about the risk. He totally got that, totally understood that. He's on the different side of acquiring property inexpensively, selling it for a higher price, creating the paper, and then, was just thinking, well, I could just sell the paper at the 12%. No, not to me. I've got to look at the risk first. So I explained that to him, and again, admired it. He totally got it. And I said, so why don't we do this? How much capital can you want, or what's the most I can pay? And I'll just buy a certain number of payments,
Hmm.
instead of the whole thing. And that's what we did. I closed on that deal, and I think we're just closed on it. First payment probably coming in this month. So there's solutions to all that stuff. But when I do a partial, it's because of that. I'm coming in at a lower investment to value ratio. And it's not just based on down payment, everybody, by the way. It's based on some other factors. There might be deals where I come in even lower than 70% because certain things I don't like about the deal. So that's criteria one. The other criteria is looking at, which I've alluded to a little bit, is we buy these things at a discount, and we buy them at a discount not to take advantage of the situation, but to recognize the fact that we're giving present dollars for future accounts receivables. Okay. That's what we're doing. And we're taking on risk along the way. What's our risk? Non-payment, property value fluctuations, all those sorts of things. So we are taking that risk on. So mathematically, it doesn't make sense for a lender who's in a totally different ball game. Remember, they bought a house or land inexpensively. They fixed it up. They sold it at a higher price. They probably got a lot of their capital back from the down payment, what they spent, and now they're creating this paper. And I've seen it change over the last year where the expectation is, well, if I write this note high enough, I don't have to take a discount. And unfortunately, that's probably because you get some people who are new to the business and they think they can do it on their own and they don't know any better. And they pay 100% of the balance. And you just can't do that. There may be a tiny, tiny, tiny sliver of a percentage of time when you can do that. But you can't because you're taking on all the risk, giving 100% of the money. And it just doesn't make sense to do that. What we need to build into, again, hedge our risk a little bit is build in a discount. So if it's a 80,000, I'll use a different number. If it's a $75,000 note and I'm buying it for 70 grand, I've got a $5,000 buffer in there between what the balance is and how much I'm in it. And that buffer stays for a long time because these notes are paid over a long time and it's principal and interest combination. So you maintain that buffer there. And that way, if you do have some of the issues of a note goes non-performing or you have to do a corporate advance for property taxes and things like that, on the payoff side, you collect all that back. So it's a way that we can build in a little bit of buffer for ourselves as well, but it's also really comes from the fact that we're looking at trading present day dollars for future accounts receivables, and we're taking on risk along the way. Look, even banks, when banks sell notes, they sell them at a discount to who? Fannie Mae, Freddie Mac, and Ginnie Mae. They buy notes at a discount, everybody. This is how it's properly done. Um, they buy it at a discount because of reasons that I just said. So it works on a huge level. It works on a small level. Why would you be an investor who's going to take on 100% of the risk, give 100% of the money up front? It doesn't make sense, everybody. So you've got to push back, and I hope the market does. That's one thing I'm keeping an eye on in 2026. I hope the market does give pushback to some of these people that are asking for 100% of UPB. Heck, I've seen people ask for 110% of UPB.
Crazy.
It's just nuts, because, well, look at the interest rate you're getting. Look what the property's worth. If they don't pay you, you can foreclose and all that sort of stuff. It's like, yeah, but you can only foreclose on what you're owed, not what you paid for the inflated amount for the note. It's the UPB that, you get paid back on, and a arrearage account, of course, as well. That's what cracks me up when people don't know that. It's like, what? You're not going to get that extra money you paid. That's not what the borrower owes. That's a premium you pay. That's ridiculous. Ridiculous that people are doing that. I don't know if any of those deals have closed, but I've seen them offered that way. Your
Yeah.
yield is typically the last thing that I look at. But again, you do these in rapid succession, if you will. But the yield is, kind of the last thing, because if you meet those other criteria, a lot of times
It's
the
all
yield
going to
works
come
out
in.
itself. It's in that 10 to 12% range. If it's not, that's when you have to go further down to go, all right, I'm at, less than 70%. I've got a good discount here. I'm paying 85%. I'll just pull a number of the balance of the loan, but I'm still only making 6%. Well, yeah, you got to lower your price.
Yeah.
So you can always renegotiate the yield after the fact, but when you look at those first two criterias, a lot of times you'll find that you're in an acceptable margin. But the yields right now, performing notes, and they've been this way for a long time, 10 to 12% is where you should set your expectations. And again, some people who are yield hunters, they look at, well, I'll pass on the 10% deal because I'm going to wait for a 13, 14, which we see 13, 14%, 15% deals. Well, prepare to sit on the sidelines,
Yeah.
and that's why in our annual report, in our portfolio last year, we bought 29 notes and we did average 14%. But we bought a portfolio, everybody. We bought several notes over the course of the year. Some of those notes are definitely at 10%, and they're good, well-paying notes. I'd never pay on a note that's a good quality note, hits all the points, and it's at 10%. 10% is a good return, everybody. And if you compared your numbers at 10% to 12% over the course of the year on a lot of these notes, it's not going to change your life, everybody. It's not going to change your lifestyle one bit. So why have your money sit on the sidelines waiting for 15%? You're waiting for, 6, 7 months to find a deal that fits that, where you could have bought something right now and your money's been working for you for 6 months
Yeah.
already. So it's really those three numbers that are the important part of these performing notes. There's no question about it. So we buy notes direct. You can go to our website, kevinshortell.com, and you'll see, sell a note, and it's very simple. Fill out the information. And if you're a note owner yourself, you can do that. If you are looking to broker notes, you can certainly find notes, put it in that thing, but just expect this is where we are. So part of where people become successful in brokering notes is they don't just take information, put it on a form, and pass it on. They look at the information,
They
they
understand
think
it.
through it, they run the numbers, they set the expectations properly for the note seller, so they're not shocked by some big discount, coming down the road.
For
But
sure. Yep.
that's what we teach there. So, all right, Dwayne, that's all I've got today. And
I
to
think it's a
start
good
off the
session
off the
going
year,
into the, yeah, absolutely.
and just keep those criterias in mind. And look, this is what I help people do. I can consult with you. We also have an elite program where I find deals for you that work, find deals that make sense because I'm putting my own money in it. I'm seeing year-end reports from some other people in the industry that sell training, and they never mention that they put money in these deals. You know why? Because they don't. My numbers show I put almost just under $100,000 of my own money this past year, 2025, that I invested in one single note at a time with my people in the elite program, and nobody else in the industry is doing that. So putting my money where my mouth is, as we say. So reach out to us. You can reach Dwayne by email. You can go to the website and sign up for get on our email list, and you can follow up with Dwayne that way. But Dwayne, your email address is just Dwayne at
Join at kevinshortell
yeah,
dot com.
Dwayne
Yeah.
at kevinshortell.com.
If they have a
And
question or, hey, I have a deal that I'm looking at and what's solve
yeah,
this episode. What's Kevin talk about? I can break that down for him as well.
excellent.
Yeah.
Very good. Okay, everybody, we look forward to putting another one together for you next week. See you later.
See ya.